Hey YouTube, it's Dimitri, and today we're going to answer a really popular question I get from students and practitioners alike, but mainly from students, which is, should I get an FRM, should I get a CFA, or should I get a CPA? So the question's most common between the CFA and the FRM. However, it is asked from time to time between the CPA and the CFA. So let's kind of dive in. So I think the best way to distinguish these is more or less the purpose they are used for. So obviously a CPA is for accounting, but a CFA is typically for general finance, so corporate finance, portfolio management, more or less traditional finance. And then the FRM is more or less for risk management. And so those of you that are working in the risk realm would want to get the FRM, but it might not be as helpful if you're doing more or less traditional finance or investing, or if you're an accountant. So the best way to really see the differences between these exams is to see a practice question that's really focused on that area of studies. So for the FRM, you can see here's a perfect example. For a sample of 400 firms, the relationship between corporate revenue Y and the average years of experience per employee X is modeled as follows. And then it gives you the equation. You wish to test the joint null hypothesis that beta 1 is equal to 0 and beta 2 is equal to 0 at the 95% confidence level. The p-value for the t-statistic for beta 1 is 0.07 and the p-value for the t-statistic for beta 2 is 0.06. The p-value for the s-statistic for the regression is 0.045. Which of the following statements is correct? So this question, you can see, focuses on regression, models. Analyzing risk is really done through models. It's not done through kind of seat of your pants. So I've been making loans for so many years. How do I feel, or what do I think is going to happen? Risk is more or less a quantitative science. It's measured mathematically, and a lot of the qualitative sides, such as in finance, is really not put into practice for quantitative finance. And then the CFA example, a company currently has a debt to equity ratio of 1.25. Common shareholders' equity is $4 million, consisting of 1.5 million shares outstanding with a current price of $28 a share. Part of the company's debt currently outstanding is $1 million of convertible bonds. Each $1,000 par value bond can be converted into 50 common shares at any time during the next 3 years. The coupon rate of the bonds is 6% with interest paid annually. If all convertible bonds are converted, the company's debt capital ratio is closest to, and then you calculate this out, right? So in this example, you can see it's traditional finance. It's using ratios. It's using more or less corporate financials and accounting to come up with some valuation or some measurement of finance. So this is traditional finance. It's not regression. It's not statistics and mathematics. It's just kind of the basics of looking at like financial accounting and the financial healthiness of a business, and then using kind of ratios to measure this. And then the last example is the CPA, which I think is by far the easiest to distinguish from the other two designations, because realistically it's only accountants that get the CPA. Here's an example of a CPA question. Catastrophe Corp has determined it is not a going concern and will likely go bankrupt. Which basis of accounting will catastrophe adopt? And then it gives you, 4 different examples here. So this is more or less pure accounting. Accounting, again, is more or less looking at rules and regulations, standard procedures such as GAAP, and then applying these methods or methodologies of standard accounting practices to company financials and making decisions. So it's financial decision making through more or less bookkeeping and accounting methods. So as you can see, there is 3 different exams. They cover 3 different areas of more or less businesses. So risk is covering risk management, more or less for banking, which is the FRM. The CFA is covering financial analysis for anything from like corporate finance to financial analysis of like your income statement and your balance sheet, all the way down to like portfolio analysis and investing. It's very traditional finance. And then the last one is the CPA. It's more or less just accounting and bookkeeping. Another great way to look at this is the books that you would have to read, more or less to work in these industries or to have this designation. So here's like an example of a book I had. This is the Introduction of Managerial Accounting. Again, it's just accounting book, solidly accounting. The second one would be the CFA, and the CFA would be solely like corporate finance. So this is Fundamentals of Corporate Finance. It's a book I used when I got my BBA in finance. And then kind of a crossover book between the CFA and the FRM would be this derivative book, Principles and Practices. This was a really good book. It covers things both on a, I guess, broad kind of business understanding level, which would be more of the CFA, and then it comes down into a little more details on more of like an FRM designation, or someone who actually works in risk management and needs to understand the mathematics a little better. And then I cringe to give you this book, but this is VARs used in risk management. The reason I say I cringe to give you this is because most business people think VAR is like, that's risk management. Yeah, it's useful in many ways, but VAR is just barely scratching the surface what risk management is. A far better book, I think, that explains what risk management and people that have the FRM designation would actually be doing, at least those that actually do like development and implementation and who are not managers, would be this book. It's Statistical Analysis of Finance and Data in S+. I love this book. It's by Carmona. There's also I think a newer version in R. S+ is like the old dead language of R. It's been updated. But anyways, this is a great and amazing book for those of you looking to get into risk management. But that's kind of the summary of the three, right? If you want to do like pure finance, investing, corporate finance, stuff like that, go out there and get a CFA. It's worth it. It looks good on the resume. It distinguishes you from the rest of the people that are applying for these jobs. And it states that you are serious about finance. If you're going out to get an FRM, that means you want to work in risk management and risk management only. You're not going to be kind of like a generalist who's going to do like portfolio analysis. Maybe if you're going to do risk analysis on portfolios and you're mainly focusing on the risk side, then the FRM would give you an advantage and you should go get an FRM. And then again, the simplest is the CPA, which is significantly different from the FRM and the CFA. And so if you're going to go be an accountant, go get a CPA. But you can see there's like overlap. So for the CPA to the CFA does cover accounting because you need accounting to understand financials of corporations and investments in corporations. And then there's overlap again from the CFA to the FRM. The CFA covers financial analysis. It covers, how different types of financial instruments work. The FRM also covers a lot of that because you have to know how financial instruments work. So how does a bond work? How does a fixed income work? How do derivatives work? How do you implement risk models onto those? And again, the CFA does cover some risk. It's a little bit in there, but the FRM again is just going to be solid risk, really focused on risk and financials, whereas the CFA is more focused on accounting and like traditional finance. So I hope you guys find that helpful. I'm a big fan of all three of them. If you're going to go into either one of the three different areas, I'd recommend getting the designation for a few reasons. One, it gives you kind of a competitive advantage over everyone else who's applying for the job who doesn't have it. Two, it shows you're serious about your industry, you're willing to spend money on it, you're willing to spend time and to learn the information in depth. And three, the continual education programs, I think is the biggest benefit for those that actually have the designation after you obtain it, because it more or less forces you to keep up with your industry, and it shows that you're like on top of it and you're a great employee because you have all the up-to-date skills. So that's my take. Thanks for watching, and as always, until next time. Thanks for watching my video. If you find it helpful, please like, share, and subscribe.